Good morning, everyone. This is Larry McMillan with a market update on Monday, March 30th before the market opens. Hope you're all staying safe. Last night, the market opened down sharply, but then reversed itself and rallied back up, and we're on the plus side today. So at this point, the lows of last Monday are still holding in there around 2180 on the S&P, and that does have a little bit of support going back into all the way to 2016, meaning that, of course, all the gains since then have been wiped out. The chart, though, of the S&P is still negative. What we're in here is an oversold rally. They typically carry up to the 20-day moving average and maybe a little bit longer than that. So I'm looking perhaps at the top here, maybe being 2730 or so, and then hopefully a successful retest of the lows. It does seem that everyone's calling for a retest, so maybe not too confident in that prediction. But in any case, the oversold rally usually does fail after exceeding the 20-day moving average. On a more positive note, we do have a modified Bollinger Band buy signal as of last Tuesday. And so that's one of the short-term signals that with the sell signal that came in January and February, of course, preceded the decline, and now we have actually the third one on the buy side right now. The put-call ratios are our most positive indicator. They've all rolled over to buy signals from very extremely pessimistic levels. It's a contrary indicator. And so that's good for the market, hopefully. The total put-call ratio is the one we're using as the driver of our strategy at this point in time. So we're buying out of the money call bull spreads based on that. Market breadth has been wishy-washy. I mean, on good days it's great, on bad days it's terrible. Technically, right now, our breadth oscillators are split. The New York Stock Exchange breadth oscillator is on a buy signal. The stocks only is not. New lows have begun to decline sharply, but we're not getting any new highs yet, so that indicator is still modestly negative. Volatility is where the action is, of course, and we've seen the peak in volatility in VIX back in mid-March, up around in the 80s. So there's technically a VIX spike peak buy signal in effect right now. The trend of volatility, though, is the more important thing, and the term structure of the volatility futures. Those are both quite negative still at this point in time. You need to see the CBOE publishes several volatility indices, VIX being the 30-day volatility. They also have one called VIX 3M, which is the 3-month volatility. You're really not going to get an all clear in this area until VIX falls back below VIX 3M, and that doesn't look like it's going to happen anytime real soon. So what do we have here? Well, we have an oversold rally within the confines, I believe, still of an ongoing bear market. So you can trade the long side. I would keep some core bearish position in place, though. And if you're looking to protect your stock portfolios and things like that, use the rally to buy protection or lighten up on the long side. So visit our website. We're having very successful time in our newsletters, the daily volume alerts and the daily strategist. And of course, we also have a number of other things that are of interest right now, including a recorded webinar that we did last week on the very important VIX SPY hedging strategy, which has allowed us to post positive gains for our managed accounts year to date. So thanks for watching, and visit optionstrategist.com.